Welcome to Sovereign Weekly. It's Friday, August 22nd, and I'm Liam, flying solo again this week, just me and the tape. And what a tape it was! Two things happened at once, which is what made it interesting. Underneath, the bond market spent the whole week screaming, and up top, the stock market spent the whole week shrugging. Long yields at 16-year highs, equities near their peaks, and everybody acting like those two facts can coexist forever. They usually can't. So here's the plan. The economy segment gets the real meat this week. Housing just fell off a cliff, and we're saving the consumer read for that. As we discussed last episode, the plumbing under the bond market gets an update in its own segment too. I'll only touch it here. What I want to do right now is the stuff that's mine. The actual price moves and the company news driving them. And there was a lot. A cancer vaccine that nearly tripled a stock. A chip giant that guided down and nobody blinked. And a couple of earnings reports where the number was great and the stock got punished anyway, which is my favorite kind of puzzle. But we start with the single loudest number of the week, Moderna, up 177% in a day. 177%. In one session. That's not a stock move, that's a resurrection. Moderna, the mRNA company everyone wrote off once the pandemic checks stopped clearing, put out late-stage trial data on a personalized melanoma vaccine, paired with Merck's Keytruda, and it worked. Meaningfully delayed cancer coming back. Merck went up about 13% on the same news, which tells you it's real and not just a meme. The whole biotech index popped almost 6% on the day. Now, okay, let me be honest about what this is and isn't, because the number's so big it kind of hypnotizes you. Here's the thing I want you to sit with. The same day Moderna nearly tripled, the biotech ETF closed down 3.5%. Read that again. The single biggest one-day biotech story in years, and the sector it belongs to went the other direction. How? Because it wasn't a sector re-rating. It was one lottery ticket cashing. Money didn't flow into biotech. It flowed into Moderna and Merck specifically, and it came out of everything else. That's the tell of a nervous market, not a confident one. When a great result lifts one boat and sinks the fleet, capital isn't feeling generous. It's rotating. And I know the question you're asking, because I asked it. If the science is that good, isn't this the start of a whole personalized medicine boom? Fair. And genuinely, maybe. The platform validating beyond infectious disease is a big deal. But the counter case, and it's not stupid, a personalized cancer vaccine means you sequence one patient's tumor, find what's unique to them, and manufacture a custom shot. For that person. That's a manufacturing and reimbursement nightmare at scale. The efficacy is the easy part now. The supply chain is the hard part, and it's unsolved. So, spectacular, real, and years from being a business. I'd hold both of those in my head at once. Okay, from the biggest up move to the most interesting non-move. Now, last week we covered Nvidia, NVDA, at length, so I'm only coming back to it because of what's genuinely new. This week, they actually guided next quarter to $91 billion in revenue. Wall Street had penciled in 92. So, a miss. $1 billion light. About 1% under. And I want to be careful here because the chip story proper, the architecture, who's winning inference versus training, that's the technology segment. And honestly, the deep dive later is a whole company in this world. So I'm staying in my lane. I only care about the market reaction to this new guide. And the reaction is the story. Because think about what the entire market has been priced on for 2 years. Not Nvidia grows. Nvidia's growth accelerates. Data center dollars getting bigger every single quarter forever. A guide of 91 against 92 isn't a disaster. It's a rounding error. But it's the first crack in the acceleration story. The possibility that the line bends from up and to the right faster to just up and to the right. Those are very different multiples. Now, Do I think 1 billion of guidance means the AI build is over? No. Come on, that's silly. The demand is still enormous. Baidu's cloud revenue grew nearly 300%. Alibaba's cloud accelerated to 45%, best in almost 2 years. The spending is ferocious and real. But here's the second-order thing nobody's connecting. Look at how they're paying for it. Alphabet went and sold $5 billion in Australian bonds this week, a company with a fortress cash position, borrowing in a foreign currency to fund CapEx. Broadcom's reportedly lining up a $100 billion debt package for AI infrastructure. Alibaba's CapEx bill for a single quarter turned their free cash flow into a $44 billion outflow. So the demand is real, yes, but it's increasingly being funded with debt instead of cash. That's what a late cycle looks like. Not the top, but not the bottom either. And a 1% guide down being enough to make people flinch tells you the market half knows it. Right. Two more, and these are the ones I actually enjoyed. The great number, terrible outcome pair. Ross Stores, the off-price retailer, popped 8% after earnings, comps up 10%, and here's the quality part, driven by transactions, not price hikes. More people walking in, new shoppers, lapsed shoppers coming back, existing ones coming more often. All three. And they raised full-year guidance. That is a genuinely excellent quarter. Merchandise margins expanded even while inventory grew, which in off-price means the buying desk is sourcing better, not just stuffing shelves. The moat's working. So why am I not celebrating? Because, and this is the part that separates a good business from a good investment, a chunk of that raised guidance isn't operations. Roughly 60 cents of the full-year number is a one-time tariff refund, non-recurring. Strip it out, and the underlying earnings guide is more like 801 to 817. Still good, but not 860. And the stock went up more than the actual business got more valuable. So the gap between price and worth, it didn't close, it widened. Here's the tell that made me smile. Management was asked to raise their long-term growth algorithm, the multi-year target. And they declined, said, and I'm paraphrasing, the right time to do that is further along. Which is honest, and also quietly damning. If two 10% quarters don't move your own long-run number, you're telling the market its enthusiasm is running ahead of your own. The business is superb. The price is the problem. That's a very different sentence from the business is broken. Which brings me to the one I want to spend real time on, the valuation corner. And last week we covered Uber, U-B-E-R. Since then, the whole story flipped on one thing, this week's earnings, where the number wasn't the problem, the reaction was. Because Uber did the opposite of Ross. Bookings guidance came in soft, and the stock dropped. And watch what management did in response. They pivoted the whole conversation to robo-taxis, autonomous rides launching in Europe, a Baidu partnership in Dubai, Pony.ai commitments, Waymo, all this future. And look, I get the instinct, but that's a 2027 and beyond supply-side answer to a 2026 demand-side question. Someone asks, why is your core rideshare growth slowing? And you answer with drones. The market saw right through it. Stock fell. Here's why this is the valuation story, though. Because the setup is genuinely wide. Uber's trading at a market cap around $139 billion, and the intrinsic value range our work puts on it runs from about $202 billion up to $356 billion, meaning the current price sits below the bottom of the range. On the base case, you're looking at a margin of safety somewhere in the mid-40s to high 40s%. That's not a rounding error. That's a real discount. So what's the market mispricing? The whole thesis rests on one spread. The price implies long-run bookings growth of under 5% a year. Uber's actually been growing bookings north of 20%, constant currency. That chasm, 5 implied versus 20 delivered, that's the entire margin of safety. That's where the value lives. And I know exactly what you're thinking. Liam, you just told me the guidance was soft. Isn't a soft guide the first sign that 20 is heading toward 5? Yeah, that's the right question, and I'll concede it honestly. A soft forward bookings number is the first real threat to that spread. It's the one thing that could compress the numerator the whole case is built on. But one soft guide is a warning shot, not a wound. The quarter didn't show bookings collapsing to 5. It showed them decelerating from a very high base. The gap has to close a lot before the discount disappears. So the discount is real. The risk is now named. And the thing to watch isn't the robotaxi press releases. It's the plain, boring core bookings number next quarter. That number adjudicates everything. Not Dubai. The mispricing is that the market is trading Uber on the guidance flinch and the AV theater, while the actual gap between price and value stayed wide. A superb franchise, arguably cheap, with one genuine crack to keep your eye on. So let me tie the week off before we hand over. Here's the thread. Moderna, Nvidia, Ross, Uber. 4 totally different stories, one common thread. In every single one, the market reaction told you more than the number did. A great cancer result that sank its own sector. A 1% miss that shook a 2-year story. 2 beats that got punished because price had run ahead of worth. This was a week where the tape was pricing mood, not math. And under all of it, that bond market screaming. Long yields at highs, credit spreads pinned tight, equities calm. That tension doesn't resolve in the stock pages. It resolves in the economy and in the plumbing. So that's where we go next, because the loudest data of the week wasn't a stock at all. It was housing starts falling 12.5% in a single month, and a consumer quietly tapping out. That's the real economy, and that's the economy segment. Let's get into it. So Liam ends the week on housing starts, and honestly, that's the right place to hand it over. Because if you want to understand what the American economy actually did this week, forget the stock tape. Start here. Because 2 numbers landed on the same day and told completely opposite stories. Housing starts. That's builders breaking ground on new homes. Fell 12.5% in a single month. July print. 1 month. And on the exact same day, the flash business surveys came out and said the economy's growing at the fastest clip in months. So which one is lying? That's the question, right? And the honest answer is neither. They're measuring 2 different economies. Let me walk it. Start with the survey, because that was the genuine surprise this week. The composite PMI, that's just a broad temperature check. They ring up purchasing managers and ask, busier or slower than last month? It came in at 56. Expected 53. Anything over 50 means expansion, and 56 is hot. Services even hotter, nearly 57 against an expected 54. Big upside surprise. And I want to be fair to it, the surprise is the information. When something lands 3 points above where the whole street expected, that's not noise, that's a signal the economy's got more momentum right now than the consensus thought. So, case closed? Economy's fine? Go home? No, because sitting right underneath that is the housing number, and housing doesn't lie about interest rates. Here's the thing an owner needs to feel in the bones. Housing is the most rate-sensitive corner of the whole economy. It's the canary. When money gets expensive, the first thing that stops is somebody deciding to break ground on a house. And the mortgage rate barely moved, 6.65%, basically flat on the week. So this isn't a rate spike scaring builders off. This is builders looking at a buyer who can't afford 6.6 anymore, no matter how long it's been sitting there. Down 12.5 in a month, down 10% versus a year ago. That's not a wobble. That's demand walking out the door. Now, and I know exactly what you're thinking, 1 month of housing starts is the noisiest series in the whole book. It bounces around like crazy. Fair. Totally fair. A single 12% drop, I wouldn't hang a recession call on it. But it doesn't sit alone. That's the point. Look at what's next to it. Retail sales, actual spending in stores, the cash register number, down 0.6% in July on the advance read. Consumers pulled back. And the personal saving rate, how much of your paycheck you're actually keeping, sitting at 2.7%. 2.7, that's scraped. A year ago, there was another 2+ points of cushion there, and it's gone. So put those together, and here's the shape. The consumer isn't spending from strength, from a fat paycheck and a fat savings account. They're spending down what's left. And when the buffer's this thin, the buffer runs out. And consumer confidence, the Michigan sentiment number, it recovered to 49.5. Recovered. That word's doing a lot of work. 49 is a recession-adjacent reading. It bounced off a truly ugly low, but the level is where you see it when people are scared. So the mood is bad and the wallet is empty, and yet the survey says businesses are busy. That's the contradiction. Let me try to actually resolve it instead of just pointing at it. The steel man for everything's fine, and it's not stupid, goes like this. The PMI is the freshest data we have, August. Housing and retail are July, weeks old. Maybe the surveys are telling you the consumer already turned the corner and the hard data just hasn't caught up. Momentum's real, unemployment ticked down to 4.1, jobless claims are low. Give it a month and the spending data confirms the surveys. That's a real argument. I'll concede the timing point. The PMI is genuinely newer, and I'm not going to pretend a July number trumps an August one. But here's where I don't buy it. The surveys ask businesses how busy they feel. The hard data measures what households actually did with money they don't have. And when those two diverge, it's usually the money that wins. Sentiment turns before the cash does. A purchasing manager feeling optimistic in August doesn't put savings back in a household's account. The saving rate at 2.7 is a fact. The confidence at 49 is a fact. The survey is a feeling. So my read, growth is real right now, and it's borrowed. It's late cycle. The engine's still running, it's just running on the reserve tank. And that, by the way, is the whole thread back to what the week was chewing on. Long bond yields at highs, credit calm, equities calm. The bond market's looking at exactly this picture and saying, I don't buy the calm. Wait, let me be precise there. The bond stuff, the spreads, the plumbing, that's the next segment. That's not mine to land. But the economy is the reason that tension exists. That's the point. Now, what would change my mind? Say it plainly, or it's a horoscope. Two things. If the saving rate stabilizes and retail sales turn positive again, actual spending, not a survey, then the borrowed growth call is wrong, and this is just a soft patch. And on the other side, core PCE lands next Tuesday. If that comes in hot, above the 0.2 everyone's penciled in, then it's not just a tired consumer, it's a tired consumer with sticky prices, and that's the ugly word nobody wants to say out loud. That's the one to watch this week. Okay, let me get out of the country, because for anyone running businesses across borders, the more interesting divergence this week was overseas. Europe. Same survey batch, and here's the split that matters. Germany. German manufacturing came in at 54, well above expectations, genuinely strong. But German services dropped under 50. France was ugly across the board, composite under 49, back in contraction. So what do you do with that? The read is, European manufacturing is quietly turning up. That's the factory floor, and it's the part levered to the global capex cycle, all that AI data center building everyone's throwing money at. But the European consumer is still flat on his back. Same shape as here, honestly. Factories busy, households cautious. And the UK consumer just isn't there. Retail sales down 0.5% in July, and the year-on-year growth basically halved, from just under 4% down to 1.6%. That's a spending economy losing its pulse. Which brings me to the one I'd actually put a pin in, Japan. And look, last week we covered yen, the carry trade, the Bank of Japan, so I'm not rerunning that. I'm bringing it back because something genuinely new moved this week. Because something moved this week that matters if you own anything with global exposure, the yen. It's been the world's cheap funding machine for years. Borrow in yen for basically nothing, park it in dollars, pocket the difference. That's the carry trade. And it's been the quiet floor under a lot of asset prices everywhere. And here's what's new since last week. It's unwinding and faster. The yen ran from 163 toward 157 against the dollar. That's the yen getting stronger, fast, which is the exact opposite of what that trade needs. Nearly 3% in a matter of weeks. And the reason's mechanical. Japan's central bank is slowly raising rates while the gap between US and Japanese yields keeps narrowing. Once that gap closes, Japanese money that went abroad chasing yield has a reason to come home. Repatriation. Why should an owner care about a currency in Tokyo? Because when that trade unwinds, it doesn't unwind politely. It's leverage coming out of the system all at once, and it hits everything. It was at the center of the August wobble a couple years back. It's not screaming yet, it's just moving in the direction it moves before it screams. So what would make me actually worried versus mildly watchful? There's a clean line on it. If Japan's central bank comes out and explicitly pauses, says, "We're done for now," below 0.75%, the carry unwind risk basically comes off the table. They haven't. They're at 0.8 and heading higher, so it stays on the watch list, orange, not red. Let me compress all of it into one thing you can carry out of the car: the American economy this week. Growth looks strong on the surveys, weak in the wallet, and the wallet usually wins. Growth is real, and it's borrowed. Abroad, factories perking up, consumers everywhere still tapped out, and a currency in Japan starting to move in a way that tends to come out sideways. And here's the natural handoff. Every one of those tensions, the bond market not buying the calm, the carry trade leaking, the cushion under the consumer worn thin, none of them resolve in the economy. They resolve in the plumbing, in the banks, in credit, in where the money actually flows when it gets nervous. That's the system, and that's exactly where we go next. So Liam's whole handoff there, it resolves in the plumbing. Okay, let me actually test that this week. Because here's the thing about credit, it leads. When the money machine gets nervous, it shows up in the banks and the bond spreads first, weeks before it ever touches your equity screen. So if the economy's really got a wallet problem, the plumbing is where I'd see it. And the honest answer for this week? Mostly I don't. Start with the banks. Bank credit. That's everything the banking system holds, loans plus securities. $19.8 trillion. And week over week, it did nothing. Flat. Round it to 0. Over 3 months, up 1.5%. So it's growing, gently, and this week it just breathed. And I know what you're thinking. Flat is boring. Why lead with it? Because flat is the story. A bank takes your deposit and it doesn't stick it in a vault. It lends most of it back out, and that lending is the money supply expanding into the real economy. When that machine stalls, credit stalls, and 6 months later, so does everything else. So flat isn't nothing, it's the pulse, and the pulse is steady. Now, under the hood, it's more interesting than the headline. An update on the labor market and payrolls we walked through last episode, business loans, the commercial and industrial book, that's companies borrowing to build inventory, make payroll, expand, that ticked down a hair on the month, 0.2. But look year over year, up 8%. 8! That is not an economy where companies have stopped borrowing. Which, okay, hold on, let me steelman the other side, because that 8% bugs me a little. Is that healthy borrowing, or is it defensive borrowing? Because there's a version where companies draw down credit lines not to grow, but because their cash is getting tight and they're topping up the tank before it gets worse. That's what you saw in early 2020, in 2008. The C&I book actually jumps right before the trouble because scared companies hoard cash. So which is it? And here's where the data actually answers me. Cleanly, for once. Because if it were defensive drawdowns, you'd expect the banks to be slamming the window shut, right? Scared borrowers, scared lenders. And they're not. The loan officer survey, this is the quarterly one where the Fed literally asks banks, are you tightening or loosening? The net percent tightening on business loans is 0. 0. Nobody net is pulling back. And rewind 2 years, that number was up near 50% tightening. So banks have gone from slamming doors to holding them open. Neutral. That's not a credit crunch. That's the opposite of one. And that lending standards number is the single most important lead indicator in this whole segment. So let me sit on it for a second. When banks tighten, defaults follow. Not immediately, about 3 or 4 quarters later, because a company that can't roll its loan is the company that goes under. Tightening today is defaults next year. So banks at neutral. 0 net tightening. That's them telling you they don't see the fire either. The wallet's thin, sure. But the people whose job is literally to price the risk of not getting paid back, they're relaxed. Real estate loans, up 0.2 on the month, up 2.5% on the year. Deposits, up 0.2. Grindingly, boringly fine. I told you at the top, some weeks this is a 3-minute segment. This is shaping up to be one of them. And that's a feature. When I tell you something turned, I want you to believe me, and I earn that by telling you the quiet weeks are quiet. Now. The plumbing itself, the reserves, the overflow tank, this is where I have to give a follow-up, because we've walked this pipe 3-4 weeks running now. And there's exactly one new number worth your attention. The reverse repo facility, the system's overflow tank, the place money market funds park spare cash overnight when there's nowhere better, it hit 20 cents. Not 20 billion, 20 cents on a scale of billions. 0.2 billion. It's empty. It is functionally completely drained. And I have to be honest with you about what that does and doesn't mean, because it's easy to make this sound scarier than it is. What has happened, the buffer is gone. For 2 years, every little funding wobble got absorbed by draining that tank. Money flowed out of it into markets and smoothed everything over. That reservoir is now dry. That's fact. What it implies, and this is the part where I stay careful, is that the next funding scare doesn't have a shock absorber anymore. It hits the actual waterline. It hits bank reserves directly. And reserves this week? Down 0.3%. Still just under 3 trillion, but down about 6% over 3 months. The direction's been one way, down, and now the cushion underneath is gone. Does it matter yet? No. And I want to be really clean about yet. Nothing has broken. Overnight rates are behaving. There's no repo stress. This is a fire alarm with no fire. Today. But it's the kind of setup where, if something does spark, there's nothing standing between the spark and the tinder. It's not a prediction. It's a lack of a buffer. Those are different things, and I'm not going to let anyone tell you the tank being empty is itself the crisis. It isn't. It's the condition under which a crisis would move faster. One more plumbing wrinkle, and then I'll let it go. The Treasury's cash account, its checking account at the Fed, is sitting near $1 trillion, up more than 20% over 3 months. When the Treasury builds up cash like that, it's pulling money out of the banking system to do it. Reserves down, cash pile up, those move together. So part of that reserve drain isn't the Fed, it's the government's own cash management. Mechanical, not sinister, but it's another straw on the same camel. Okay, now the part I actually care most about, the disagreement. Because credit markets and equity markets are looking at the exact same world, and when they price it differently, that's the tell. So, high yield spreads. That's the extra yield you demand to lend to the shakiest companies over lending to the government. It's pure fear, measured in basis points. It's the compensation for the chance they don't pay you back. And it's at 275, 2.75% over treasuries. That's about as calm as this thing ever gets. Barely moved on the week, couple basis points wider, basically noise. Investment grade, the safe borrowers, 82 basis points, also flatlined. So the credit market is pricing a genuinely serene world. No stress, no defaults coming, everything's fine. Now here's the tension, and I'm going to name it before I pretend to resolve it, because I'm not sure I can. The economy segment just told you the consumer's tapped out, the growth is borrowed, the bond market doesn't buy the calm, and here's high yield saying, what problem? Somebody's wrong. Either the credit market is complacent, pricing perfection at the exact moment the cushion's worn thin, or the equity and macro worriers are early. And I'll be straight with you. At 275, there just isn't much room left. You've got maybe 20, 30 basis points of tightening before you hit the floor, and if a real credit event shows up, 2, 3, 400 basis points of widening. That asymmetry is terrible. You're getting paid almost nothing to carry the risk that it turns. But, and I have to concede this because the skeptic in the chair is right, tight spreads have stayed tight for years. Complacent is not a catalyst. Being right about the asymmetry and being right about the timing are completely different sports, and anyone selling you a date is selling you something. So I won't. The disagreement is the story, not the resolution. Quick word on housing finance, then I'll wrap. 30-year mortgage, 6.65%, down a whisker on the week, up 14 basis points over 3 months, which is to say, stuck. High enough to keep the housing market frozen, nobody with a 3% mortgage is selling to go buy at 6.5%, and not moving enough to change anything. Frozen, still frozen, next week, probably frozen. So let me compress the whole thing into one line you carry out of the car. The plumbing this week? Banks open for business, credit priced for perfection, and the shock absorber officially empty. Nothing broke, but the thing that used to catch the fall is gone. So the day something does break, it'll break faster than it used to. And that's the bridge to where we go next. Because the single thing propping up that serene credit market, the thing keeping the calm, it's the assumption that the world stays quiet, that oil stays put, that the Gulf keeps recycling its petrodollars into treasuries, that nothing sparks. And the world does not stay quiet on command. So let's leave the plumbing and go to the map. Geopolitics, the oil premium, and the places where the spark actually comes from. That's the world, and that's next. Right, so we leave the plumbing and go to the map. And here's the thing that's been bugging me all week, the one I want to sit with. Last week, we covered the oil and energy price story and the Iranian confrontation. Since then, the frame is flipped. The story you're being told now is that it's contained, that the talks in Oman are constructive, that Trump traded the military threat for an economic one, and economic pressure is the safe kind. Nobody dies at a Treasury desk. Calm story. Comfortable story. And I want to test it. Not because I want to be the guy shouting about oil, I really don't, but because the behavior underneath doesn't match the calm. What's genuinely new since last week is the who and the how, so start there. So start with what actually happened. Treasury Secretary Bessent stands up and says, his words, he wants to collapse the Iranian government. Secondary sanctions, an ultimatum to every U.S. trading partner. Keep buying Iranian crude and you get tremendous economic consequences. That's not a de-escalation. That's swapping a hammer for a garrote. And, okay, quick gloss, because secondary sanctions gets thrown around like everyone knows what it means. It doesn't mean the U.S. sanctions Iran. It means the U.S. sanctions whoever trades with Iran. You force a third party, a Chinese refiner, an Indian bank, to choose the American financial system or Iranian oil. You can't have both. That's the whole mechanism. It's a blockade run through the plumbing instead of the Navy. And here's why it might actually bite this time. China takes something like 90% of Iran's oil exports. So the entire question, the whole ballgame is one thing. Is Washington willing to sanction a big Chinese bank to make the point? And I know what you're thinking. You're thinking, come on, we've heard toughest sanctions ever a dozen times. Maximum pressure, 2018, remember? Iran's export just routes around it. Teapot refineries, ship-to-ship transfers off Malaysia, a shadow fleet. Every round hits a smarter evasion machine than the last. Fair. Genuinely fair. That's the base rate. And the base rate says, announced, not enforced, and probably never fully enforced. So let me steel man the calm, because it deserves it. Iran's been under sanctions since 2018, and it's still standing. Bessent himself said the U.S. is unlikely to restart large-scale combat. China has zero incentive to help Washington strangle one of its cheap crude suppliers. Put all that together, and yeah, you get to, this is theater, price it at zero. That's a real argument. I'm not dismissing it. But, and this is the part the calm story skips, two things changed underneath it this week that don't fit the script. First one. There's reporting that a military junta is consolidating power in Tehran. IRGC commanders, the Revolutionary Guard, becoming the dominant voice over the foreign ministry. And why does that matter for your portfolio? Because the whole "it's contained" case rested on the Oman channel, on the idea that Iran's diplomats could cut a face-saving deal. But military institutions under existential pressure don't take off-ramps. They escalate. Because escalation is how you prove you're still in charge at home. So the off-ramp everyone's assuming is there just got a lot less reliable. And that's not a statement. That's who's holding the phone. Second thing, the Houthis, Iran's proxies in Yemen, hit a Saudi airport and an Aramco facility with drones this week. Now, Iran doesn't need to close the Strait of Hormuz if it can just show you Saudi oil infrastructure is soft. And we have the template for exactly this. Abcake, September 2019. One strike took out 5.7 million barrels a day, 5% of global supply, gone in an afternoon. Crude spiked 15% in a single session. Now, Saudi restored it in weeks. That's the ceiling and the floor of what this kind of attack does. But the point is the proxy network is live. It's being used. Right now. So, junta more likely to escalate, proxies actively swinging, Treasury threatening China. That's the behavior. Now, the step that separates this from a guy with a bad feeling, is it priced? Look at the number. Brent, 95 and change a barrel, up about 3% on the week. So, is that the market pricing the risk? Sort of. Barely. It's pricing the press release is what it's pricing. Because history says a real, enforced secondary sanctions regime against Chinese buyers adds $10 to $20 a barrel in the first few weeks. 10 to 20. We've got 3%. So the market's tipped its hat to the announcement and priced almost none of the tail. And here's the tell that makes me sure of it. The VIX. Equity volatility, think of it as the price of insurance against the stock market lurching, it's sitting at 16. 16! That's not far off complacent. Actually fell 6% one of the sessions this week, even as the Aramco drones were flying. Come on, read those two together. Oil ticks up and the fear gauge goes down in the same week. That's a market that has decided the oil move is a Middle East story that stays in the Middle East. Contained. Somebody else's problem. And the corporate side says the same thing, louder. High-yield credit, the extra yield you demand to lend to a shaky company instead of the government, so basically the price of corporate fear, sitting at 2.75%. Barely moved. Now, remember the point raised last segment. Energy shocks take 4 to 8 weeks to show up in corporate lending, so we're inside that window, which means one of two things. Either the market's right and this all dissolves, or the corporate lending market just hasn't gotten the memo yet. And historically, it's usually the second one. So what do I actually believe here? Because I promised evidence, not posture. Honestly, the base rate is on the side of the calm. Sanctions get announced and evaded far more often than they bite. If I had to bet, Besant's words don't become a sanctioned Chinese bank. But, and here's the asymmetry, the price is set as if that's 95% certain, and it's nowhere near 95% certain. Not with a junta in Tehran and drones over Aramco. You're being asked to take the nothing happens side of the bet at almost no discount for being wrong. That's the mispricing. Not the direction, the confidence. So what would tell me I'm wrong to worry? Clean falsifier, no date on it, because anyone who gives you a date is selling something. If China's teapot refineries keep buying Iranian crude at the same clip 60, 90 days on, and the Iranian crude discount doesn't widen past 15%, then the siege is theater, and the calm was right, and I tip my cap. In the other way, the day OFAC names an actual Chinese bank, or Lloyd's pulls war risk insurance on Iranian cargo, that's the moment the $10 to $20 move stops being history and starts being the tape. Now, what does this mean if you own businesses for the long haul? And this is where I pull the drama back down, because that's the honest thing to do. It means almost nothing dramatic day to day. You don't rebuild a portfolio around a strait that hasn't closed. What it means is more modest and more useful. When the calm is this cheap, the businesses that get hurt by a fuel cost spike, the airlines, the chemical guys, the ones running thin on their own cash, are the ones getting no compensation right now for a risk that genuinely exists. And the ones with real pricing power and their own cash flow just don't care as much. That's the whole lesson. Not sell everything. It's notice what you're being paid to ignore. Let me do one quick second one, faster, because it rhymes. India. Same oil, different victim. India imports about 85% of its crude. Brent at 95 is a straight tax on that current account deficit. Call it a couple $1 billion a month more for every sustained $5 move. And yet the rupee's basically flat, 95 and change to the dollar, not budging. Why isn't it moving? Because, same reason as everything else this segment, global money's in comfort mode. VIX low, spreads tight. So capital's flowing into Indian stocks and bonds and papering over the trade damage. Fine. Works. Until it doesn't. That offset is confidence dependent, and confidence is the one input that reprices in an afternoon. Flip the sentiment while oil's still high, and you get a currency move the spot rate isn't discounting at all. Same shape as the oil trade, the risk isn't gone, it's just been quietly handed to whoever's holding the peg. And there's a wrinkle I can't not mention, because it's almost funny. India's now shipping refined gasoline into Russia, because Ukrainian drones have knocked out enough Russian refining that Russia, a crude exporter, is importing petrol. So Indian refiners are running the full spread. Buy the cheap Russian crude, sell the product back to Moscow, both legs. Whoever designed the price cap did not draw that up on the whiteboard. So, one line to carry out of this segment. The whole map right now is the same trade wearing different clothes. Oil's edging up, and everything that should twitch alongside it, volatility, credit, the rupee, is dead calm. That's not the risk being gone. That's the risk sitting somewhere the price isn't looking yet. And that's the perfect bridge to where we're headed next. Because the single loudest thing propping up all this calm, the reason the fear gauge can sit at 16 through drones and shuntas, is the machine everyone's convinced pays for everything. The AI build-out. The compute, the chips. And this week, the chip world sent up a flare almost nobody's reading right. A price hike that tells you something real about who has the power and who's about to pay for it. That's the tech, and that's next. So the flare, it's a memory chip price hike. And I know, memory prices went up sounds like the least interesting sentence anyone's ever said on a podcast. Stay with me. Because underneath it is a genuinely strange idea that landed in the research this week, and it flips one of the load-bearing assumptions of the whole AI build-out. The assumption that we just need more of the expensive, fast memory. Forever. Okay, let me back up and build it properly, because the whole thing only lands if you get the mechanism. When an AI model answers you, it does two completely different jobs, and almost nobody splits them apart. Job 1. It reads your question. The whole prompt, all at once. That's called prefill. Job 2. It writes the answer, one word at a time, each new word depending on all the words before it. That's decode. And here's the thing. Those two jobs stress the hardware in totally opposite ways. Reading your question? That's heavy math. The chip's number-crunching muscles are pinned, and the memory's basically bored. Writing the answer, though, writing is the opposite. To produce each single word, the model has to haul its entire brain, all its billions of settings, its parameters, across the chip. Then do it again for the next word, and again. So decode isn't a math problem. It's a moving problem. It's a delivery truck problem. And that's where this special memory comes in. It's called HBM, High Bandwidth Memory. Think of it as loading docks stacked right up against the processor, so the model's brain can be hauled in and out fast. That closeness is the whole point. It's also brutally expensive to build. You're literally stacking memory chips vertically and wiring straight down through them. It is the single hottest, most supply-constrained thing in the whole AI supply chain. And I know exactly what you're thinking. If writing is a delivery problem, and the delivery bay is the bottleneck, then obviously you want more delivery bays, more HBM. Case closed. Buy the memory guys, right? Here's the part I didn't see coming. 5 papers dropped this window, all pointing the same way. And the argument is, for a big chunk of these jobs, you don't need the loading dock. You need a warehouse. The idea's got a name, High Bandwidth Flash, HBF, and it's the boring cousin. It's basically fast, solid-state storage, the same family of chip that's in your laptop, in your phone, dressed up with a fatter pipe to the processor. Way slower than the fancy stacked memory. But, and this is the number that matters, somewhere between 4 and 20 times cheaper per gigabyte. So why would slower and cheaper ever beat faster and dearer? Because a lot of these jobs aren't actually starved for speed. They're starved for room. Picture a mid-sized model. Call it a 70 billion parameter model. Respectable, the kind an enterprise actually runs. To hold its full brain, you need around 140 gigabytes. And a single top-end chip's fancy fast memory holds maybe 80. So the brain doesn't fit. Full stop. You've got 2 ways out. Buy more of the expensive chips just to get more of that premium memory. You're paying for a Ferrari fleet because you needed a bigger garage. Or spread that model's brain across a little array of the cheap flash. The warehouse. It fits, it's a fraction of the cost, and for the jobs where you're room limited rather than speed limited, nobody driving the car can tell the difference. Now, the honest part, because this is where tech reporting usually lies to you. This is papers, peer-reviewed, quantified, roofline analysis, which is just the formal way of proving which of the two, math or memory, is the actual bottleneck for a given job. Real work. But it is not a hyperscaler standing up and saying, "We ran production traffic on the cheap stuff and customers couldn't tell." That deployment hasn't happened. The invalidation trigger the desk keeps flagging is exactly that. One production workload, real traffic, matched speed. Until that prints, this is a strong signal, not a shipped fact. Demo, paper, product. 3 different things, and this is squarely in the paper column. But let me steelman the case that this fizzles, because it's a real case and it isn't stupid. Those 5 papers all ran in clean rooms, controlled benchmarks. And production traffic is a zoo. It's spiky, it's mixed, everyone shows up at once. The gap between works beautifully in a benchmark and survives Tuesday afternoon is exactly where 100 promising memory ideas have quietly died before. So, could this stay a niche overflow trick for cold, rarely used parts of a model and never touch the main line? Yeah, honestly, it could. I'll give the bear that one. The burden of proof is on the flash. But here's why I still think the flare is worth reading. The second order stuff, which is always where it gets interesting. For years, everyone modeled demand for that premium stacked memory as a line that only goes up. Monotonic. Fancy word just means never bends down. More AI, more of it, forever. What the research quietly did this week is name the specific scenario where that line is wrong. Not demand collapsing, nobody's saying that, but softening at the margin right around 2027, 2028, exactly when a big wave of new premium memory capacity is scheduled to come online. Build the factory for a demand curve, then have someone rigorously argue a slice of that demand is about to defect to the cheap tier? That's a real problem, and it's a new one. And who's on which side of it? That's the delicious part. The 2 giants that dominate the fancy memory, they also make the cheap flash. Same buildings, different business units. So they don't get wiped, they get reshuffled. Some demand walks from the high-margin loft over to the lower-margin warehouse down the hall. Same tenant, worse rent. Meanwhile, the pure flash players, the ones whose whole life is that cheaper solid-state storage, they've spent years as the unloved, cyclical, nobody's darling corner of the chip world. And this hands them a brand new demand story they didn't have a month ago. And here's the callback that ties it to the top of the show. Last week we covered oil and energy prices, and this is a follow-up on that, because since then the shape has only sharpened. Crude creeping, everything that should twitch sitting dead calm. This is that. Same shape. Everyone's priced the AI build-out as, buy the most expensive, most constrained thing, it can only go up. And the risk isn't that AI demand vanishes. The risk is it quietly relocates to the cheaper tier, somewhere the price isn't looking yet. Now let me connect this to the price hike because that's what actually flared. If a real cheaper substitute is arriving, why are memory makers raising prices right now?
Because right now they've got total pricing power. The build-out's roaring, the fast memory's scarce, and there's no shipped alternative yet. That's the tell. A price hike into a window where the substitute is on paper but not on the loading dock is exactly what you'd expect from someone who can see the substitute coming and is harvesting the moat while the moat still holds. It's not a sign of strength that lasts. It's a sign of strength being cashed in. So, one line to carry out. The AI story got sold as the expensive thing goes up forever. The quiet research this week says, for a real slice of the work, cheap and roomy beats fast and dear, and the only thing standing between paper and product is one honest production benchmark nobody's published yet. Watch for that print. It moves more than a price hike ever could. And that's the perfect handoff. Because everything we just talked about, who's got the pricing power, who's harvesting a moat while it lasts, and who's about to have the ground shift under them, that's not an abstract question this week. It lands on one specific company. And that's exactly the seat we're taking next. The deep dive, one name, examined properly, right after this. So pick it up right there, because the company you just described, the one harvesting a moat while the ground shifts, that's AMD to the letter. And here's the number I want to open on. Blended gross margin last quarter ran just under 54%. A year ago, it was under 40%. That's not a slow grind. That's a business changing shape in real time. And I mean shape. 2 years ago, this was a PC and console chip company with an AI side hustle. Now, data center's 58% of the whole thing. 58. It was 43 a year before. So the legacy PC business, that's the tail now. The dog is accelerated computing. You're listening to Sovereign Weekly. I'm the host, this is the deep dive, and we're going to take AMD apart properly, because the headline this week and the actual story are two very different animals. Okay, how does it make money? 5 buckets. Server CPUs, that's EPYC. AI accelerators, that's Instinct. Client chips, the PC stuff. Gaming, the console royalties. And embedded, which is the old Xilinx franchise. But really it's 2 engines now, server CPU and the AI accelerator. Everything else is scenery. And here's the thing that makes the bull case sing. It's fabless. They don't own a single fab. TSMC builds the silicon. So when revenue went from $23 billion to $37.5 billion, CapEx barely moved. $500 million, $1 billion, in that zone. You know what that does to incremental returns? It makes them absurd. On new capital deployed the last 3 years, call it 51%. 51 cents of profit on every incremental dollar. And I know exactly what you're thinking, because I thought it too. 51%? Then why does the headline return on capital look like garbage? Because it does. Trailing return on capital, the whole base, is under 6%, below the hurdle. A business earning under its cost of capital is, technically, destroying value on what it already owns. So how do both things live in the same company? Xilinx, that's the answer. There's about $42 billion of goodwill and intangibles sitting on the balance sheet from the Xilinx and Pensando deals. 2/3 of the invested capital is acquired, and it hasn't earned its keep yet. So the old money drags the average down, the new money compounds like crazy. The slope is what matters. That trailing number went from under 1% to 3 to 6, climbing about 2.5 points a year. On that slope, it clears the hurdle in a couple of years. If. Big if. Hold that. Now the moat, and this is where everybody gets AMD wrong, so let me be careful. There are 2 moats. They point in opposite directions. Conflate them and you misprice the whole thing. Moat 1, EPYC, the server CPU. Real, widening. And you saw the mechanism in the tech piece this week. It's chiplets. Boring word, huge deal.
AMD builds the CPU as a bunch of small dies stitched together instead of one giant slab. So they only print the expensive, cutting-edge compute bits on the pricey 2-nanometer wafers and put the plumbing on cheap old process. Better yields, faster ramp, lower cost. The competitor is still leaning monolithic and can't match it below 5 nanometers.
And why does that stick?
Switching costs. A hyperscaler's validated x86 across 1,600 plus cloud instance types. To move off that, they requalify their entire software estate. One write-up this week put the migration cost at $500,000 to $2 million per workload. You don't do that because the other guy's chip is 5% faster. Server CPU revenues guided up over 70% into 2027, margins expanding on the way. That's the textbook signature of a real moat. Margin up while volume's up. That one, I believe. Moat 2, Instinct, the AI accelerator. And here's where I get skeptical, because that's not a moat, not yet. It's a funded second source standing next to somebody else's moat. Now, the bull will push back, and it isn't stupid, so let me make it in its strongest form. The bull says, AMD doesn't need to beat Nvidia. The AI accelerator market's headed for over $1 trillion. Be the credible number 2, take modest share, and modest share of $1 trillion is tens of billions. You don't need the crown, you need the runner-up podium. Fair. Genuinely fair. And the engineering backs half of it. The tech desk made this point sharply this week. AMD bet on memory bandwidth as the real bottleneck for AI inference, and they were right. Inference, that's running the model once it's trained, is memory-bound, not compute-bound. AMD packs more high-bandwidth memory per box. 8 of the top 10 AI labs run Instinct for inference. That's not nothing. That's a genuine wedge. But, and here's where I sit back down, that same memory advantage is a margin trap. And the smartest question on the earnings call nailed it. Analyst asks Lisa Su, 50% more memory per box, in a world where memory is the single most cost-inflated part in the industry, doesn't that eat your margin? And her answer told you everything. She was confident on supply, good visibility into memory allocation for 2027. But on economics? She conceded they'd modify the memory footprint for customers where it doesn't pencil. Translate that. The headline advantage is partly a negotiating chip. The 56% margin guide isn't being comfortably held, it's being defended. And the tell that really got me? Different analyst asks, when you say data center more than doubles in 2027, how much of that is the GPU? Name the number. And she wouldn't. Gave you a hard, specific over 70% on the CPU. On the accelerator dollars, deflected. Double-digit billions. Directional. See, that's the part I don't buy as an annuity. A management team sitting on a contracted accelerator business quantifies it. The refusal to name the number is the number. It says real, ramping, but not yet locked down enough to put on the record. The confident figure is the CPU. The hopeful figure is the GPU, and the competitive brief this week hammers it home. Nvidia is converting to its next generation at 1,000 racks a week. Rubin already in the fab on an annual cadence. AMD's big volume is 2027 weighted, a full product cycle behind. Every quarter of that gap, the CUDA software install base gets deeper. That's the moat AMD's fighting, and it's Nvidia's to defend, not AMD's to build. Okay, management. Lisa Su. Let me give credit where it's earned because it's a lot. Revenue up 34% last year. Beat the last 2 quarterly guides, both above the top of the range. Net cash balance sheet, actually net cash, about $1.7 billion, plus a fresh $5 billion revolver. She is not levering into the peak. That's discipline. On operating execution, she's earned the benefit of the doubt. But here's the number in this whole dossier that made me stop cold. Stock-based comp. On paper, the accounting charge is about 1.8 billion. Dilution looks trivial. Share count's basically flat, up less than 0.5% a year. Fine, right? No, not fine. Because the stock's risen about 2.33 times since the average grant date. So the real economic cost of neutralizing that dilution today isn't 1.8 billion, it's over 4 billion. And now put that next to owner earnings, what the business actually earns for its owners after charging that real comp cost. That number's about 4.4 billion. So economic stock comp is running at 96% of owner earnings. 96. Read it twice because I had to. The cost of the currency management pays itself and its staff nearly eats the entire owner earnings base. And the buybacks? They don't reduce the count for you and me. They just mop up the comp dilution. 4 straight years, outside owners got 0 share count accretion. The treadmill runs, nobody moves. And the insiders. This week, the chief sales officer sold nearly 8 million in stock. The dossier read the whole insider ledger. Option exercises, same-day sales, net selling into strength. Nobody on that team is signaling this thing is cheap.
Which brings us to the number the whole show's been circling. Valuation. And I'm going to say this in percentages. No price targets, just what the price assumes. At today's level, owner earnings yield, economic basis, is about 0.5%. 0.5%. Against a 10-year Treasury near 4.5. That's a negative spread of almost 4 points. You are paying roughly 180 times economic owner earnings. You are not buying this year's earnings. You're buying 2027 and beyond, and you're paying the whole bill in advance. And here's the part that's hard to wave away. The dossier runs a full valuation grid, conservative to optimistic, every scenario. The current price sits above every single cell, above the bull case. The base case implies the business is worth something like 76% below where it trades. To get even a modest margin of safety, you'd need it down around 80%. Now, steelman the bull one more time, because I want to be fair to it. The bull says, that base case normalizes the margin down to mid-teens and charges comp at economic cost. And if the ramp converts and the margin holds, then trailing is the wrong base. The growth path is conservative and the market's right, not the model. That's a real argument. I'll concede it fully. If the accelerator ramp turns those gigawatt intentions into shipped margin-holding racks, the picture changes. But notice what that costs you. You're paying the entire bull case today and taking the execution risk for free. That's the trade at this price. Not, is AMD a good business? It is. It's, are you paid to wait? You're not. So what kills the thesis? Either direction. Downside. The accelerator ramp stalls into intention. The first big deployment slips past the first half of 2027. That's the primary breaker. Or, gross margin drops below 53 for 2 straight quarters as memory cost bites. Or, the quiet one, EPIC share actually reverses as a rival's foundry recovers. Last week we covered Intel. Since then, the competitive brief flags something genuinely new. Intel's long-term Google supply deal and improving yields. Not a reversal, a ceiling on how fully AMD captures the contested sockets. Upside breaker, to be honest about it, a signed, dollar-denominated take-or-pay accelerator contract. Not a gigawatt intention, a real committed backlog number from one of the big buyers. That single disclosure lets Sue finally name the figure she wouldn't, re-rates the GPU business from second source to annuity, and closes the gap fast. Watch for that print. It's the whole ballgame. And one quick beat on where the stock actually stands. Positioning, not a call. It trades above every fundamental scenario in the grid, and it's re-rated more than 2-fold since the average comp grant. So technically and fundamentally, you're at the same place. The price has run ahead of the demonstrated earnings, and it's pricing a 2027 that hasn't printed yet. That's the tension in one line.
So, let me pull the whole episode together, because it actually rhymes this week. We opened on funding plumbing, on who's got pricing power and who's cashing a moat in while it lasts. And AMD is that theme wearing a logo. Two moats moving opposite ways. One real and widening, the boring CPU nobody tweets about. One hopeful and contested, the shiny AI chip everyone prices as if it were already won. The market bought the shiny one at the price of certainty and got an intention instead. That's the carry home. In an AI build-out this loud, the durable edge is usually the quiet one, and the thing being cashed in, the memory price hike, the harvested margin, the comp paid in a stock that tripled, that's strength being spent, not strength that lasts. Great business, extraordinary engineer at the helm, and a price that's already clapped for a show that hasn't started. The business survives every hard question. The price, at this level, doesn't. All right, before we go, the necessary part, said plainly. Everything we talked about today is for education and information only. It is not a recommendation, and it is not personalized advice for your situation. And you should know the host and the platform may analyze and may hold views on any of the securities we discussed today, AMD included. That's the show. Thank you for giving me the hour, genuinely. This has been Sovereign Weekly, and we'll be right back in your feed next week. Take care of yourselves out there.